Listen to me very carefully. I'm going to tell you something today that might save your financial life. We are staring at one of the most dangerous market environments I've seen in 40 years. Three sectors are about to devastate investors who don't see what's coming. And if you're holding positions in any of these areas, you're lighting your money on fire. I'm Kevin O'Leary, and I don't sugarcoat things when it comes to your money. I've been doing this for 40 years. I've seen boom and bust cycles that would make your head spin. I've built companies from nothing and sold them for hundreds of millions of dollars. And I've watched people lose everything because they didn't listen to cold, hard data. That's not going to be you. Before I get into the details, I need you to do something for me right now. Hit that subscribe button, smash it. Why? Because this channel is about protecting your wealth, growing your cash flow, and making sure you never run out of money. The information I share here could literally save your retirement. If you're serious about your financial future, you need to be part of this community. We're building an army of smart investors who understand that protecting your wealth is just as important as making it. So subscribe now. Now let me set the stage. The market is at a dangerous inflection point. We're seeing valuations that haven't been this extreme since the dot-com bubble. The Shiller-Cape ratio is hovering around 40. That's well above the historical median of 16 and approaching levels we saw before the internet bubble burst in 2000. What does that mean for you? It means that many assets are trading at prices that have nothing to do with their underlying fundamentals. It means speculation has replaced discipline. It means emotion has replaced analysis. And here's what most people don't understand. In every bubble, there are specific sectors that get hit the hardest. In 2000, it was technology companies with no earnings. In 2008, it was real estate and financial stocks. Today, there are three sectors that are so overvalued, so dangerous, that if you're holding them right now, you need to take action. Central banks are explicitly warning about this. The Fed, the IMF, and central banks around the world are flagging fast-rising valuations as a systemic vulnerability. Fund managers are listing these risks as their number one concern. This isn't speculation. This is data. I've lived through the 2000 crash. I've lived through 2008, and I'm telling you right now, the warning signs are flashing red. The question is, are you going to listen, or are you going to be one of the people who loses 40, 50, 60% of their net worth because they were too stubborn to see reality? Sector number one, artificial intelligence and overvalued tech stocks. The first sector you need to avoid right now is the artificial intelligence bubble. And yes, I'm calling it a bubble. Look at the numbers. AI-related investments are driving 75 to 90% of major index gains since 2022. That's insane concentration. Market concentration has reached historically dangerous levels. When one theme is responsible for nearly all the gains, you don't have a healthy market. You have a house of cards. Let me be clear. I'm not saying AI isn't transformative. It is. But that doesn't mean every AI stock is a good investment. In fact, most of them are absolute disasters waiting to happen. Here's the brutal truth. Valuations have become completely detached from reality. Companies are trading at multiples that assume perfection for the next decade. There's no room for error, none. And when expectations are that high, even good companies can crater 40 or 50% overnight when they miss earnings by a few cents. Goldman Sachs and Morgan Stanley are predicting a 10 to 20% decline in equities over the next 1 to 2 years. The Monetary Authority of Singapore just issued a warning that tech stocks are overvalued and could trigger sharp corrections in the broader market. These aren't random commentators. These are the institutions that move trillions of dollars. Let me give you a specific example. Tesla. I think Tesla is trading at one of the highest valuations I've ever seen relative to our fundamental analysis. It shot up over 50% after the presidential election. That's not based on earnings growth. That's not based on fundamentals. That's pure speculation. And when the music stops, the people holding those shares are going to get crushed. Consumer cyclicals are now trading at a 19% premium. That's one of the highest premiums we've ever seen in that sector. A huge portion of that is because of Tesla. The stock may not be the most overvalued it's ever been in history, but it's pretty close. And it's not just Tesla. Look at the entire AI infrastructure space. Companies are spending billions on data centers, chips, and infrastructure. Capital expenditures as a share of operating cash flow have jumped from 35% to 70% for the major hyperscalers. That's not sustainable. When companies start relying on external financing for massive projects, that's when bubbles peak. History shows that over and over again. Here's what happens next. Returns inevitably decline as competition intensifies, infrastructure capacity exceeds demand, and suddenly all that investment doesn't generate the returns everyone was expecting. We've seen this movie before. We saw it in the late 1990s with fiber optic cables and telecom infrastructure, billions poured in, and then the sector collapsed. The capital cycle theory is clear. When excessive capital flows into specific sectors, returns decline. It's that simple. And right now, AI is drowning in capital with expectations that are impossible to meet. So what do? You stay away, you don't chase momentum, you don't buy stocks at 50 or 75 times forward earnings just because they have AI in their business description. You wait, you watch, and when the correction happens, then you look for value in the wreckage. Shiller-Cape ratio at 40, AI stocks driving 75–90% of index gains. Tesla up 50% post-election sector number 2, commercial real estate, especially office properties. The second sector you need to avoid is commercial real estate, particularly office properties. This sector is facing a structural crisis that most investors don't fully understand yet. Let me give you the numbers. Office vacancy rates hit a record 19.6% in Q1 2025. That's the highest on record ever. In some cities like Seattle and Austin, vacancy rates are at 27%. In San Francisco, it's over 20%. These are depression-level numbers, and it gets worse. In 2025 alone, $957 billion in commercial real estate mortgages are maturing. That's nearly triple the 20-year average. Think about what that means. Property owners need to refinance almost $1 trillion in debt in an environment where interest rates are still elevated, property values have collapsed, and lenders are pulling back. The CMBS delinquency rate reached 7.29%. That's the highest level of distress we've seen in that market. For office properties specifically, the CMBS delinquency rate hit 11.01% by the end of 2024. That's a historic high. Bank lending for commercial real estate is down 58% from pre-pandemic averages. For the office sector, it's down 65%. Lenders don't want this paper. They see what's coming. And what's coming is a wave of defaults. There are 278 banks that are highly vulnerable because of their exposure to commercial real estate. They have high concentrations in CRE loans, and many of them are sitting on significant losses. If default rates climb, these banks are in serious trouble. The work-from-home trend is not going away. Office space demand is still about 30% below pre-pandemic levels. Even with return-to-office mandates, companies are not leasing more space. They're using their existing space more efficiently. That means there's structural oversupply that's not going to be solved by economic growth. Now, some markets are stabilizing. Manhattan has seen some improvement. New York Midtown has largely returned to pre-pandemic rent levels, but those are the exceptions. Most markets are still in serious distress. And here's the thing, even if you think you're buying at a discount, you're catching a falling knife. Property values are still declining in many markets. Cap rates haven't fully adjusted. And when the refinancing wave hits and defaults spike, there's going to be even more forced selling. I'm not saying there won't be opportunities in commercial real estate eventually. There will be. But right now, the risk-reward is terrible. The downside is massive, and the upside is limited. That's not where smart money goes. If you own office REITs, you need to take a hard look at your position. If you own direct office properties, you need to understand your refinancing risk. And if you're thinking about buying into this sector, I'm telling you, wait. Wait for the distress to fully play out. Wait for valuations to reflect the new reality. Don't try to be a hero. Office vacancy at 19.6%, 957B in maturing loans, CMBS delinquency at 7.29%, office CMBS delinquency at 11.01%, sector number 3, altcoins and speculative cryptocurrency. The third sector you must avoid is altcoins and speculative cryptocurrency. And I speak from personal experience here because I recently made this exact move myself. I eliminated all altcoins from my portfolio, every single one. The only cryptocurrencies I hold now are Bitcoin and Ethereum. That's it. And there's a very specific reason for that decision. My internal team conducted a comprehensive analysis of cryptocurrency performance. We looked at 24 different cryptocurrencies and ran the numbers. Here's what we found. A portfolio equally divided between Bitcoin and Ethereum captures over 97% of the returns of a diversified crypto portfolio that includes dozens of altcoins. Let me say that again. Bitcoin and Ethereum give you 97% of the returns. Altcoins add almost nothing, but they add massive risk. They add volatility, they add complexity, and they add regulatory uncertainty. The Clarity Act passed the House on July 18, 2025, with a 294 to 134 vote. That legislation is going to reshape institutional crypto investment. And here's what's going to happen. Institutional capital is going to consolidate around the two largest, most defensible cryptocurrencies, Bitcoin and Ethereum. Everything else, all those irrelevant tokens, they're going to disappear. They have no use case. They have no institutional acceptance. They have no regulatory clarity. And as compliance frameworks mature, they're going to get eliminated. I've watched altcoins in this current market. They're not bouncing back after corrections anymore. In previous cycles, when Bitcoin would drop, altcoins would recover quickly. That's not happening now. Investors have realized that owning only Bitcoin and Ethereum is enough. Everything else is moving with much higher volatility to the downside and not recovering because they have no fundamental value. Now, I'm not saying Bitcoin and Ethereum are risk-free. They're not. I keep my Bitcoin position limited to under 5% of my total portfolio, similar to my gold allocation. Your mantra should be preservation of capital with yield. There's only so many things you can do without taking inordinate risk. But if you're going to be in crypto at all, you stick with the blue chip assets. Bitcoin is digital gold. It's a store of value. Ethereum has a smart contract ecosystem and institutional utility. Those are defensible. Those have liquidity. Those have regulatory acceptance. Everything else, garbage. Pure speculation. And when regulation tightens, which it will, those tokens are going to zero. Don't be the person left holding worthless coins because you were chasing 100x returns. The crypto market is maturing. It's becoming institutionalized. And in that environment, only the strongest, most liquid, most compliant assets survive. That's Bitcoin and Ethereum. Everything else is noise. Bitcoin and Ethereum capture 97% of crypto returns. Clarity Act passed July 18th, 2025, altcoin non-recovery in corrections. Now let me reinforce why these three sectors are so dangerous and why discipline matters more than ever. First, understand the pattern. Every bubble follows the same arc. You get a transformative innovation, people get excited, capital floods in, valuations disconnect from fundamentals, speculation replaces analysis, and then something triggers a correction, and everyone who was chasing momentum gets destroyed. In 2000, it was the internet. Everyone believed the internet would change everything. They were right, but that didn't mean every internet stock was a good investment. Most of those companies went to zero. Even the survivors like Amazon lost 90% of their value before recovering years later. The same thing is happening now with AI. Yes, AI is transformative, but that doesn't mean you should buy AI stocks at any price. Valuation matters, earnings matter, cash flow matters, and right now those fundamentals don't justify the prices. I remember when I was building my education software company, we had projects that everyone loved. The technology was exciting, the vision was compelling. But when I looked at the numbers, I could see that some of those projects were going to lose money. I killed them. I didn't care how much people loved them. The numbers don't lie. That's the mentality you need right now. Don't fall in love with a story. Don't chase momentum. Don't buy something just because it's going up. Look at the fundamentals. Look at the valuation. And if the price doesn't make sense, walk away. For commercial real estate, the structural problems are even more obvious. This isn't about sentiment. This is about math. You have massive oversupply, you have collapsing demand, you have a refinancing crisis, and you have lenders who don't want the exposure. When I moved my personal residence out of New York years ago, I did it because I was tired of writing massive checks to a state government that wasted my money. But I also understood the trend. High-tax states with bad governance were going to see outmigration, and that was going to hurt real estate values. I was right. The same principle applies to office properties. The trend is clear. Companies are not going back to pre-pandemic office usage. That demand is gone permanently. And any investment thesis that assumes a return to 2019 levels is delusional. You don't fight structural trends. You don't try to catch falling knives. You wait. You wait for the pain to be fully priced in. You wait for forced selling to create real value, and then maybe you step in, but not before. And with altcoins, the lesson is simple. Complexity is the enemy of returns. When you can get 97% of the returns with 2 assets instead of 20, you eliminate 18 sources of risk for almost no cost. That's smart portfolio management. I don't invest in things I don't understand. I don't invest in assets without liquidity. I don't invest in sectors without regulatory clarity. And I don't invest in anything that doesn't generate cash flow or has a clear path to generating cash flow. Altcoins fail on all those criteria. They're complex, they're illiquid, they're regulatory nightmares, and most of them produce nothing. They're pure speculation. That's not investing. That's gambling. The market doesn't care about your feelings. It doesn't care that you love the AI story or that you believe in cryptocurrency or that you think office buildings are cheap. The market cares about earnings, cash flow, and return on capital, period. And right now in these 3 sectors, the math doesn't work. The risk is enormous, the downside is clear, and the upside is extremely limited. So what do smart investors do? They avoid these sectors, they preserve capital, they wait for better opportunities. They don't try to be heroes. Let me summarize what we've covered today. 3 sectors you must avoid right now. First, artificial intelligence and overvalued tech stocks. Valuations are at bubble levels. Concentration is extreme. Returns are going to disappoint. And when this corrects, it's going to be brutal. Stay away from stocks trading at ridiculous multiples just because they have AI in their description. Second, commercial real estate, especially office properties. Vacancy rates are at record highs. Nearly $1 trillion in debt is maturing this year. Delinquencies are spiking. Banks are pulling back. And the structural demand isn't coming back. This sector is facing a wave of defaults and forced selling. Don't try to catch this falling knife. Third, altcoins and speculative cryptocurrency. Bitcoin and Ethereum capture 97% of crypto returns. Everything else adds nothing but risk. As regulation tightens and institutional capital consolidates, those irrelevant tokens are going to disappear. Stick with the blue chips or get out entirely. This is about discipline. This is about making smart decisions based on data, not emotion. This is about protecting your wealth so you can live the life you deserve. The market is expensive, the risks are elevated, and these 3 sectors are particularly vulnerable. If you're holding positions in any of them, you need to take a hard look at whether that exposure is worth it. I've been doing this for 40 years. I've built companies, I've sold companies, I've seen fortunes made and lost. And the one constant is this: the investors who survive and thrive are the ones who have discipline. They don't chase, they don't speculate, they protect their capital first, and they only take risk when the reward clearly justifies it. Right now, in these 3 sectors, the reward does not justify the risk. So stay away. Build a portfolio based on fundamentals. Focus on dividend-paying companies with strong balance sheets. Diversify across sectors. Keep some cash for when real opportunities emerge. Don't be the person who loses 50% of their net worth because they were too stubborn to listen to the data. Be the person who protected their wealth, stayed disciplined, and positioned themselves to take advantage when the correction creates real value. If you found this valuable, I need you to take action right now. Smash that like button. This tells the algorithm to share this video with more people who need to hear this message. Share this video with your friends and family. Send it to people you care about. They need to understand what's happening in these markets. This information could save them from financial disaster. Leave a comment below. Tell me what you're seeing in your local market. Tell me if you agree or disagree. Tell me what sectors you're concerned about. I read these comments. I want to know what you're thinking. And consider becoming a member of this channel for exclusive content. We're building a community of serious investors who understand that wealth is built slowly, methodically, with discipline and patience. This isn't about getting rich quick. This is about building wealth that lasts. This is about protecting what you've worked your entire life to accumulate. This is about making sure you never run out of money. We're building an army of smart investors who make decisions based on cold, hard data, not emotion. Who understand that protecting wealth is just as important as growing it. Who have the discipline to walk away from bad investments even when everyone else is buying. That's what this community is about. So hit subscribe, join us, and let's protect our wealth together. Stay smart, stay disciplined, and remember, the market doesn't care about your feelings. It cares about fundamentals. It cares about cash flow. And right now, in these 3 sectors, the fundamentals are screaming danger. Protect your wealth and live the life you deserve.